Nvidia beat sales and earnings expectations, gave a stronger than expected forecast for the current quarter sales, and they announced a huge buyback package. But the share price fell in the after hours trading as Nvidia's investors got just too used to fireworks and simply focused on what could go wrong next. So attention shifts to the economic data starting from today. The US GDP and the Eurozone inflation updates are on due menu du jour, and the US PCE core index is due tomorrow. So welcome. This is Swissquote's Daily Market Talk. So yes, ladies and gentlemen, Nvidia generated a record 30 billion US dollar of sales in the second quarter, up by 122%, more than the double compared to the same time last year. The profit surged 166% to 16.6 billion US dollars. The company said that they expect to sell 32.5 billion US dollars in the current quarter. That's higher than 31.9 billion US dollars penciled in by analysts. And they announced a 50 billion US dollar worth of share buyback program. I mean, they could hardly do better, right? So the actual results and the forecast both beat the average market expectations by a comfortable margin, and there was nothing that the company could do more to keep its investors' enthusiasm going. But hey, they actually fell short of the highest estimates on Wall Street. When I say highest estimates, I am really talking about like huge numbers for the third quarter revenue that range from like 32 to all the way up to 38 billion US dollars, for example, which is obviously off chart, but which is also the reason why Nvidia's stock price looked like it's off to the moon, and it actually challenged all odds and rumors that it may be a little bit too high and inflated. So guess what? Investors who were probably attending the Nvidia's watch party at a bar in New York, Manhattan, were quite not impressed by the comfortable revenue and earnings beat from Nvidia last night, which was, by the way, a seventh consecutive quarter beat for the company and the fifth consecutive quarter beat of more than 2 billion US dollar for its sales. And still, they sent the stock price nearly 7% lower in the after hours trading. So the shiny results from Nvidia were clouded with the delay of its next generation Blackwell chip, and also the rising worries that competition will soon arrive to tap into Nvidia's monstrous market share that actually stands near 80% for the advanced chips and also its profit margins. So in this context, the big technology companies like Meta and Google, for example, are all working on their own chips. And we also hear the names of a few AI startups, including Cerebras, D-Matrix, and Grok, more often in the news. So these companies are out to compete Nvidia with as advanced and powerful chips, but for cheaper prices. So Cerebras, for example, even claims that the chip that it builds is 20 times faster than Nvidia's Hopper chips and sells at just 10 cents per million tokens for smaller models. So if that number doesn't make sense to you, the cost of using Nvidia's H100 GPU can actually range from approximately $3.60 to $4.10 per hour, depending on the region and specific cloud providers' pricing model. So there is a massive cost gap here that developers are out to explore. And that actually combined with the news that Nvidia is also under the DOJ investigation regarding whether it has abused its dominant market position doesn't make the Nasdaq futures look good this morning. At the time I'm talking here, they're actually down by around 0.62% right now. Now, speaking of tech, Supermicro Computer dived another 20% at yesterday's trading session after announcing that they will delay filing their annual financial disclosures just a day after Hindenburg Research threw mud on the company, saying that they had glaring accounting red flags, evidence of undisclosed related party transactions, sanctions and export control failures, and also customer issues. Remember that? That was earlier this week. Well, the delaying of their report may actually, some people think that Hindenburg can eventually be right on his claims. So all in all, mood in the big technology stocks is not great this week, but the British and European futures seem little affected by the Nvidia and the latest big tech news. The futures point at a positive at the time I'm talking here this morning, and the waning appetite in the big technology stocks could actually cause more rotation toward the non-technology sectors around the world, as the Federal Reserve and otherwise are on course to start or continue cutting their interest rates in a couple of weeks from now. That means that the S&P 500's equal weight index, for example, could continue to close its gap with the technology-heavy normal weight index, but the upside potential could only be lower, obviously, with the remaining S&P 493, which could, barely make investors dream more than the Federal Reserve's interest rate cuts benefits on their valuations. Now, elsewhere, the US dollar index rebounded at yesterday's trading session from year-to-date low levels, although the US two-year yield that best captures the Federal Reserve rate expectations continued its descent below the 3.90% level. Now, today and tomorrow, investors' attention shifts to economic data. The US will reveal its latest GDP update today and its core PCE index, the Fed's favorite gauge of inflation, tomorrow. And over here in Europe, the Eurozone countries will start revealing their own flash CPI figures today and tomorrow for August, and the aggregate number will fall tomorrow morning in the Eurozone. Now, the US economy is expected to have grown 2.8% in the second quarter. That's double the number printed in the first quarter, but the price pressures are expected to have eased. And also, despite the strong-looking second quarter GDP figure from the US, the growth in the third quarter has likely slowed, according to Atlanta Fed's GDP now forecast as pointing at 2%. Therefore, even a figure in line with expectations today may not discourage the Federal Reserve, those if the price pressures continue to show further progress toward the Federal Reserve's 2% policy target. Here in Europe, tomorrow's CPI figures are expected to confirm a further slowdown in the Eurozone inflation. And that, combined with the sluggish economic data and environment at the old continent, could eventually reinforce the expectations that the European Central Bank could cut more than the 50 basis point cut that's currently baked in the market prices. The Federal Reserve, on the other hand, is expected to cut by 100 basis points, mind you, which is also a bit overdone in my opinion. So, the euro dollar is off the recent highs and has room for a further downside correction from the actual levels. And across the channel, cable remains a bit below the 1.32 mark on expectation that the Bank of England is set for a less aggressive but obviously a more realistic rate cutting path in the coming quarters and months than its American peer. But the warnings from Mr. Starmer earlier this week that October's budget will be painful could actually weigh on Britain's growth outlook, and we could eventually see the sterling appetite wane near the overbought levels against the US dollar. Finally, in China, the week that's seen another big rock fall, I'm talking about PDD, doesn't improve, as UBS just lowered its growth forecast for this year and for next year to 4.6 and 4% respectively. So you would remark that these numbers are significantly below the official 5% growth target from China, and they are quite funded on the realistically bad state of the country's real estate market and also a sluggish economic recovery. Now, the latter obviously weighs on the sentiment in energy and metal markets. US crude was again down by nearly 1.90% at yesterday's trading session, and WisdomTree's industrial metals ETF is back below its 200-day moving average. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments your reactions and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.